Hello, everybody, and welcome. I'm Bonnie Halper. I write the weekly Startup One Stop newsletter. Comes out every Tuesday morning. I'll put the link in the chat. And I also work with founders on their pitch decks and their executive summaries and now ghostwriting because you guys don't know how to write those things in the way investors like to see them. And we all know it's true. So we host these every 2 weeks. They're always in the newsletter. And I want to thank Joseph Katz for hosting us. Joseph, tell us about you.
Morning, everyone. Thanks for joining. Joseph Katz. I am a startup marketing guy. I've been helping companies grow for 15 plus years, I guess, at this point. If you're thinking about customer acquisition, go-to-market strategy, that's where I help companies, and excited for today's conversation. Always fun when Joe and Glenn are on the mic.
It's always fun.
And feel free to post your contact information in the chat, and I'll share links to previous recordings as well.
So we'll go around the room first, and we'll have the attendees introduce themselves. What do you think, guys? Yes? So, Scott, we always have everybody introduce themselves for the newcomers here. So, Scott, tell us about you.
Did you say Scott?
Yes, I did.
Oh, I was drinking coffee, and it's just I'm Scott Purdy, one of the founders of Sine. Our CEO, John Kaler, is also on this. Most of you probably know we have an app that allows you to make movie. I'll let John talk about it a little bit more. And I really enjoyed that talk about, moving up. That's why I'm starting at the very, very bottom, because I can't go any lower. So I'm moving up. But I do enjoy the small things in life. I took a nice walk this morning. It was just beautiful. It was like 49.50. And yeah, I feel good after taking that walk.
Thank you. So, John College, I guess we should go with you next. And then
that makes sense.
Yeah.
Good morning. Yeah, Joe, it's right. This looks like Friday mornings. But good to be here. Sine is developing a I have allergies today, man, they're bad. Is developing an app that will crowdsource video from events, activities. It has all kinds of possibilities, and we are close to getting it actually working and then fundraising. So I'm looking forward always to hearing about investment, because investment is where we're heading. And we still have not seen anybody else make this concept happen. And that's because it's complicated, but it's really exciting to try. So glad to be here this morning.
Other John McDallasberry.
Me? God, I've been kicking around for about 30 years in advertising, entertainment, and technology.
And we go way back.
Yeah, we do. We go way, way back to the very beginning of all this stuff.
Yeah.
I mean, I'm probably best known for a live event that happened on the internet called Kasparov versus Deep Blue. Put that together. Let's see. From there, ended up at Ogilvy as their worldwide CTO. After that, I was executive vice president of interactive for Sony, over all interactive initiatives they were doing. Found a division I really liked. Me and 3 other guys bought it. That's now Live Nation Merchandising. Started a speech recognition company that I sold to Earthlink. Search engine company that got invested in by InQtel. Started doing some scary stuff for the NSA, so I sold that to a hedge fund. Had a advertorial gaming company which did games for brands as advertising, everything from PGA to FedEx to.
And we try to keep them a little shorter, John, just so that we
Okay.
have. Okay.
Then I exited, and now I'm here.
Yes. And I'm going to have John speak at one of our breakfasts soon. You'll do that for us, right?
Sure.
Yeah. And tell us about the guitars. There's a couple of nice guitars hanging back there.
I dropped out of college for a couple of years and was a musician.
Now, is that a Schecter up there that I see on the one, or trying to see which guitars you have up there?
Dr. Brian Sykes, welcome. Always, I'm a big fan.
Yeah.
Thank you. Welcome. Thank you for inviting me here. So calling from Durban, so afternoon my time. But I'm a physician by training, but also a manager of a private syndicated portfolio. So I love everything that Glenn said. I did my clinical research because it can specialize in our program on neurobiological origins of human behavior. behavior. So you can't imagine at 19, in my second year of medical training, and inherited equity in private holdings company. So that was my entree into entrepreneurship. So when you talk about all of these kinds of behaviors, it's very interesting because everything shifted. And I remember an old Jesuit principle that said, show me the boy at 7 years old, and show you the man.
Yeah.
So, you know, behaviors are always consistent. They're always the human brain, because it lets preserve and conserve energy, is built for status quo. So I love these kind of investor talks because, as Kristen said in the AngelSpan office hour session, we don't tend to think about these things as most important. Like, these things don't, you know, they're not on your balance books, right? But they have a different return. I call return on value. So it's a very interesting conversation. So thank you for allowing me to be here.
Carol.
Hi, I'm Carol Donahue. I'm a data scientist in Toronto. I do data science advisory for startups, particularly in the area of AI integration into product.
Ah, thank you. Chris Sorensen, one of my favorite curmudgeons.
Can you hear me now?
Yes.
Hey guys, I'm Chris Sorensen. I'm here in Chicago. I'm in my car at the moment, so if you hear a crash, you know what happened. I wrote a book called The Innovator's Secret Formula about product market fit for startups. And I'm currently in a startup which is pioneering a new asset class called TREATS, Tokenized Real Estate Investment Trust. And we are looking for partners, investors, and co-conspirators of all types. I put my LinkedIn in the chat. Hit me up.
Ah, thank you. Craig.
Hey, Joseph, Bonnie, and Joe. Thanks as always, getting my day started out here in Los Angeles. I was going to model what John said about kicking around because I've been in banking for over 25 years. And then when he started talking about all of his foundings and exits, I was like, I am not going to do that because I have been kicking around in banking and I far less that I can add into the equation than that. As you see behind me, I'm with Chase. I basically lift small businesses out of our Beverly Hills office out here across the country, looking to basically lift small businesses and create a runway for commercial. Been in specialty banking for like 25 years. As Bonnie knows, what I really want to do is be an AI artist. So I'm working. Thanks, Scott. I'm working on it. So hopefully you folks will follow me because that's really what I have fun doing, is creating editorial AI art. So we'll see where that takes me in the future. So thanks. And Glenn, thanks for jumping in here.
Ian.
Sorry for the delay. Good morning, everybody. Ian Garmes. I live in Toronto. I'm the COO of Virtual Film School, which is based in LA. And as I mentioned on the chat, we're about to partner with a company that I met on Joe's call last year, I guess. So things are picking up, and you know, the fundraising is underway. So yeah, I would say things are looking pretty good. I don't want to say the name yet.
Okay, all right.
Until the time is right, but I'm sure you probably know who he is.
Okay, fine, be that way. Shelley.
Gosh, I feel like an interloper here, listening to all of you and your various accomplishments. I'm a reformed academic, I think is the best way to put it. And a few weeks ago, I decided to start a company, and I've been introduced to this group by Brian, who was alumni at the place that I did my MBA. So I'm like 6-7 weeks old, so I'm just here for inspiration. So cool. Company's called Create Vet, and I'm planning to develop in-house diagnostic testing for pets.
And I owe you some intros. I owe you some intros. That's a good, but I'm going to interject here because this is a good example. And this is me being crappy, but this is also, this is just a input for founders. I think, you reached out. I definitely have some founders I want to connect you with that I think could be helpful. I think I mentioned that the last time I was on, it might've been on office hours with Joe, or it might've been on one of Bonnie's calls, but one of the things that happens again, not trying to make excuses for myself. I just lost track of it. So I'm an analog guy. So it's on a reminder on a sheet here with about 200 other names.
Yeah, I have to send you some reminders too.
Yeah. And so eventually I might remember to get to it, but I think that it's just a really good example where I think you pinged me probably 2 weeks ago is a rough guess in my mind. I would just be as a founder, just and not singling anyone out. I'm just simply saying, I think this is why founders have to follow up with people like me, that potentially, and who's like me. Well, I have 300 portfolio companies. So like me being somebody who has a lot of obvious follow-up that I have to deal with, ping them, chase them. I mean, I know you don't want to be aggressive or rude or anything else, but honestly, for me, it's almost like an virtual assistant component because it's somewhere on my list, but I've lost track of it. So sorry about that, Shelly. I didn't mean to ping on that, but I just wanted to let you know, as soon as I saw you, I was like, oh crap, I need to do that. So that's how that, just for everybody else, kind of just a reminder of how important it is. I don't want to say chase, but it really is that. I don't really know how else to put it.
Thank you. I said to somebody last night at a Philly startup event that I'm kind of big enough and ugly enough and old enough at this point in my life to do that, like to reach out. So you were actually on a post-it note somewhere that I saw Joe holding up to follow up with you. So but thank you for that. I appreciate it.
Yeah, it's almost never. I mean, some people will just blow you off, and I'm certainly that can happen. I'll get people who send me who are raising $20 million on their $100 million raise, and I'm a pre-seed fund. So I'm not going to really waste time on that follow-up. There, I get dozens of those. I get at least, I would say at least 10 of those a day. I'm not going to follow up on those, but for anybody that I'm interacting with, and I think most VCs and most family offices, I think will at least give you a yes, no, help, no, whatever. Sorry, Bonnie. I just wanted to jump in with that.
So I keep getting a message that my internet connection is poor. So if I go off camera, that's why. Jimmy.
Thanks, Bonnie. I think the key word is proactive, right?
Yeah.
Big proactive.
Yeah.
Take control of the destiny. Yeah.
I'm Jimmy. Been in Houston for 14 years, was raised in California. This is my third company founding. I'd one acquisition that I was a part of for multifamily apartments. One startup vegan noodle product that had shut down because of the supply chain. And now I'm working on sustainability with Sustain City. And I have a couple of co-founders. And we're trying to build a marketplace to integrate causal AI and digital twins to run simulations, optimization, find root causes of problems in businesses, cities, and governments.
Oh, thank you. I'm like, Patrick.
Hey everyone, good to see everyone. Patrick Fraley, based in New York City, lower middle market investment banker. So we help with selling businesses, buying businesses, raising equity, debt in some situations. Love working with founders, and always love hearing whoever Bonnie brings on. It's always a great time. So thank you again, Bonnie.
Oh, thank you. Randy.
Okay, hi there, everybody. Good morning. Randy Seif. I'm in New York City. We are launching a new global impact luxury brand called Troon, and we sit at the intersection of sustainability, fashion, technology, and philanthropy as part of our go-to-market strategy. I unfortunately have to hop off to another call right now, but I'd love to catch the recording.
Oh, absolutely.
Glenn, I'd love to connect with you at some point. Based on what you just said, I think we should connect for sure.
Great.
Thank you.
And Kyle.
Good morning, everyone. Kyle Barrios, formerly from New York at Deloitte and now in Boulder, Colorado. early angel and consultant with early pre-seed startup founders. So happy to be here. Thank you.
And welcome. Okay, Glenn and Joe, take it away. Just give us a little bit of your background and then.
Yeah, Patrick Fraley and Alec. I don't want to run your show, but you had a couple more.
Did I miss Alec?
And Patrick. And Pat.
Oh,
Did Patrick go? Oh, I'm sorry.
Yes,
Okay.
Patrick. I didn't see you, Alec. You snuck in.
They just joined him.
Snuck in. Yeah. I think I just introduced myself, but
yeah, you just
yes, you did.
It was harder to see you. I think it was probably the challenge. Yeah.
Okay.
Okay.
And so then for me, my name is Alec Bogus. I am Joe's colleague, actually, believe it or not. So I work with him at AngelSpan. I don't know how much Joe's revealed about what he's doing, but we are partners in crime and have been for over a few years now. So looking forward to being here. Bonnie, great to see you.
Oh, you too.
And I have to say it every time. What people don't realize is that Alec and I are sort of cast out of the same physical mold, 5'9", white guys, and he was one of the top 30 high school basketball players in the country, in the state of Texas, when he graduated from high school.
Wow,
this kid is an epic athlete. Yeah,
fantastic.
And a newlywed.
Yeah, and
a newlywed. Got married.
Newlywed, that's right. Brought the hardware.
Yeah.
Got the hardware. Yeah.
We did an office hours from Colorado where he got married back in September.
Oh, that was
20th.
the.
Yeah.
That was me. Yeah. Great time.
Joe, you want to give a little background, or you want me to go? How do you want to handle it?
You go. Yeah, you go ahead.
Yeah, just real quick. I think a lot of people here have heard me before. I was a longtime founder. I ended up actually, it was sort of, I don't know if I've talked about this, but I ended up going to law school, and there's a funny story to that. I had my best friend in law school. At my law school, they would cut the very bottom of the class every term. And each of the first 3 cuts, he was the last person to make it. And he's like, I'm not going to survive. So he decided he wanted to start a business, had no idea what he was doing. I didn't necessarily have any idea what I was doing, but I had actually made an invention in high school and had sold that. So he's like, you must know something. So I ended up starting a business with him. It became the largest legal placement company for law students in the country, supplanting a company that had been around for a long time, and they ended up buying it. And so that sort of started my entrepreneurial journey. And from there, I ended up doing another 14, like that wasn't, in my opinion, a startup. It wasn't a particularly technical endeavor. It was more of a small business. But I did 14 startups after that. I exited 9. I had 3 IPOs. The first one was a pretty big one with Lehman back in 98. It was a company called Mediaplex. I was the original CEO there before Greg Grafman came in for the offering. Worked with Peter Cohen and the Lehman team. That was about a $4.5 billion IPO. From there, you get a reputation, and so I ended up doing, getting it's a lot easier to get money after that. And so ended up building some relationships later. After I stopped doing startups, I did a lot of turnarounds for hedge funds. So SAC Capital, Steve Cohen, that team, Ramius, which is now TD Cowen, which is again Peter Cohen, who was Lehman, and Jeff Solomon, who run that group. Jeff was really one of my mentors early on. So that was sort of my world. I went from small business to startups to turnarounds, public company turnarounds, broken toys. And then this started on a bet. I hate to say it because it diminishes what we do at Quake, but this started largely as I just thought there was a better way for a family office to approach investing through venture. And I made a comment about it at an event with a few other families. They gave me their 1-month landscaping budget for their 8th vacation home as my ongoing joke about it. And then I had to do it. And that's how Quake started. And we're now on our 8th fund. We're going to launch our 9th fund in Q1, Q2. We're figuring all that out right now.
Peter Cohen, holy cow.
Yeah, good, crazy. If you ever want to talk, so there's some great stories. I don't think I'll put them on recording, but if you want to talk next time we talk, Joe, I'll tell you some great stories of my first meetings with him. Crazy, interesting guy.
I was at E.F. Hutton right out of college for 5 years, and when Shearson Lehman Brothers bought E.F. Hutton, and so I got more of Peter Cohen than I ever wanted. Holy cow. Yeah, I started the public markets. I had a brokerage account in college, and I'll never forget it. It went from, I was the annoying college student with a $2,000 summer jobs brokerage account to when I would show up and be researching a company at the Payne Weber branch there where my account was, the brokers would get up and say, "What are you looking at?" Because I just had a natural instinct for it. I had no idea. It just seemed easy. And if I knew what a hedge fund was, I could have run one in college. So that was my background in 5 years at E.F. Hutton, and found that's a sales job. It's not a finance job. And was able to go to what's called the buy side, the fee-based, what you would properly label a multi-family office. And it changed the trajectory of my life. My boss was old San Francisco money and had classic pedigree and CV. And we knew each other from a duck hunting club, and he invited me to come in. And I brought a lot of skills he didn't even know about. Long story short, when he got diagnosed with cancer, he said, "Run the company till I get back." And he never came back. And I ended up taking over the company after he died, and then buying it back from the European bank that bought him, the Bank of Liechtenstein. And that was in '93. And we were right there at 3000 Sand Hill. And a year later, the internet commercialized, and all hell broke loose right under my nose. And we had a lot of central figures in the world of venture capital and ancillary industries as clients. And so I had just had a front row seat. The Band of Angels, which is sort of the granddaddy of the modern era of angel groups, that was founded in my office by my subtenant, Hans Severance. So I had a series of what I call Forrest Gump-like experiences that I just happened to be in the right place at the right time because of who my boss was, where we were located, and when I was there, pre and then post, of course, internet. But what got revealed to me was just how unprofessional the process was in how people invested in startups. It was basically optics and social signals that largely drove people's willingness to write a check. And so I've been on a quest for 20 plus years. AngelSpan is the second company, the first, and our legacy funds division is the second. The first one was called Angel Legacy. And if you think about what's out there today, Angel Legacy was the third funding portal on the internet for startups. Now there's thousands with crowdfunding and everything else, but we were the third behind Garage.com and Off-Road Capital. We were the first cap table management. Well, this is all one company. The first portfolio reporting tool. So you could actually, if you built a portfolio, you could actually track your portfolio like you would from your Schwab statement, or like what I had, the software I had to manage money in the public markets. Advent was the software. In fact, I called Stephanie DeMarco, who is the founder of Advent. They were in San Francisco and they went public. And I called her, and we were an early customer. And I called her and said, "Hey, Stephanie, I'm going to, let me ask you something. Are you an angel investor?" She goes, "Yeah." I said, "How do you track the CEO of the state-of-the-art public portfolio reporting service? How do you track your angel investment?" She goes, "Oh, I'm embarrassed. It's off a spreadsheet." I went, "I'm going to fix that. You want to be involved." So we were also the first portfolio reporting tool and the first investor relations, so that investors can get good information to expedite their due diligence, and then obviously monitor their portfolio after they chose to make a decision. That was all one company. And we raised a bunch of money, got to revenue, but it was way too much. I was trying to boil the ocean, and there was no market for it. There wasn't a lot of people that had my background of being in the middle of both being
Welcome to a startup, Joe.
Yeah, I know. I know. I got to tell you, this guy named Frank Washington, I'll never forget as long as I live. I sat down with him, and he said, "Look, before you start spending a lot of money in your program, maybe you want to go do a little market research, see if there's an appetite for this. Go spend 25 grand on a market research survey from your target market." I went, no, I don't need to do that. I know this is going to, oh my God, I wish I'd heeded his advice, because there was no market. It was a market of one, and it was me. I was trying to build something I knew I needed. And anyway, long story short, fast forward, AngelSpan and our legacy funds division is the second coming of Angel Legacy, which is to bring the tools, tactics, expertise, and processes to bring sophisticated investment management practices into the early stage venture asset class. The years ago, I was told by a real smart PhD in finance guy who was the architect of the algorithmic data vendor that I used to manage money. We were data-driven money managers. We didn't talk to Wall Street analysts or anything. So we just used data. And he was the architect of the principal data vendor subscription service. And I met with him back after I was doing Angel Legacy, and I told him what we were trying to. He says, "Joe, I heard you're starting another company." I said, "Yeah." He said, "What are you doing?" I gave, angel invest, all this stuff, we all know. And he looked at me and he said, "If you do that, you will lower the cost of capital for entrepreneurs. You will lower the equity risk premium investors assign the asset class, and you'll move the efficient frontier up and to the left." Now, that's all shit that went over my head at the time, and I wrote it all down. And he was right. I went and looked it up. But what he also said was really succinct in what we're aspirationally trying to accomplish. He says, "You'll do for the venture asset class what Michael Milken did for junk bonds." And that was profound. If you really study what Michael Milken did, how he figured out what he did for junk bonds, it's exactly the same, because that's what happened in junk bonds. By training people on standardized research, by training people to take a portfolio approach to junk bonds versus underwriting them one transaction at a time, people were assigning too much risk because they weren't viewing the transaction within the context of a broader portfolio, nor were they getting the benefits of diversification to diversify what's called non-systematic risk. So long story short, that's what AngelSpan aspires to do. So anyway, that's a longer introduction than most of you cared to have, but it gives you a little more context.
Oh, thank you. So what do you guys want to talk about? I said I would do the state of funding, but I know you guys are going to talk about whatever you want to talk about. So what
funding's getting better. That's one quick comment, just not, it's not necessarily what to talk about, but I will say funding's getting better. I think one of the nice things that we have is Joe and I both have we have view of a large number of teams, right? And we know who's out raising capital. And it's fascinating over the last 30, 45 days, but I think really 30 days, how much we've seen deals closing, deals that were maybe out in the market. You might look at it and think, okay, a deal was in the market for 4 months and it just naturally came to a close, or it was in for 6 months and it naturally came to a close. No, it was in the market for 4 or 6 months and it was just really not going anywhere. And then in the last 30 days, you saw a lot of those people that were kind of in talks, but not really doing anything, just move. So definitely seeing that. Just as a side commentary, I think that and I'm not economically bullish per se, but I just think that aspect of the economy, there certainly is some optimism right now for founders who are out raising capital. It's definitely gotten a little easier. One of the things I wanted to talk about, I told you and Joe, not really for any particular for this call, just something that's been on my mind, is it occurred to me, I always tell our founders at Quake that they don't really compete for, it's bullshit. I thought it was true for a long time, but they say they don't compete for capital. There is an element to that is true. Like, they're not competing for my capital per se. We have a certain amount reserved. We have a certain amount that we'll allocate to any particular company. So there's no real issue. I suppose if we ran up against the reserve, there would be. But what ends up happening, that I was talking to you and Joe about, Bonnie, is that there's only so many people Okay, so I just wanted to lay this out to founders, because I think what I've determined, and I knew as a founder, is that even with a fund in your corner, even with 3 funds in your corner, 4 funds, 5 funds, doesn't really matter. The founder is still on an island. Even if they can make introductions, it's really on you to do it. And I'm not trying to be, again, pessimistic or take anybody down or whatever. I don't want to start your morning on a crappy note, but I just realized this. I mean, Quake has 300 companies, about 2,500 co-investors, about 100, just under 100 LPs. I was thinking about I started thinking about us, and then I was thinking about smaller funds. And by smaller, I don't mean less capital. I mean funds that maybe have 20 or 30 or 40 portfolio companies. Invariably, what happens is they have they generally have fewer co-investors because they don't need to sit there and build this massive network. They have a natural network of co-investors, and they probably stop with the very best ones. In Quake's particular instance, we probably have 300 really good co-investors, including all of our LPs. So maybe 200 outside of and our LPs, and then 2,500 total. That means we got a bunch that are just kind of people that we can contact, but they may or may not regularly do co-investment on our deals. Why am I talking about all this? Well, if you think about it, you're going to reach out for capital and you're going to reach out to a fund manager, and it seems like, okay, they're really going to be able to help you. And I'm going to look around and I'm going to figure out the 5 or 10 people that I know that are probably a good fit for your business that are deploying capital. The problem is it becomes an issue over time because I've got so many teams that are asking for those introductions, and I can't hit that investor with, every week with more deals and just completely inundate them. They get burned out. They basically, it's not even a matter, like some people will say, are they out of capital? No, they're not out of capital. They just have so much bandwidth, and they don't. One of the constant complaints you'll get from high net individuals and family offices, to Joe's point about management tools, a huge complaint is actually just tracking all the crap they're in. So you can't just bomb them with 20 deals every week. It's not feasible. So I'm constantly, as a fund manager or portfolio manager for my startups, trying to think about, okay, what did I send Joe last week? What did I send Ronald? What did I send? Like who have I sent deals to? So I have to do this kind of dance, like this fund or this family office fits this portfolio company, but they're already looking at 3 other deals. I've got them at max capacity right now. So instead I have to look over here. So I think there's this natural tendency to founders, and what's the value in this for founders? There's a natural tendency that when you land a fund or you land a strategic investor, that you're maybe a corporate venture partner, that you've kind of arrived and that you can kind of lean on them, and you can. But I think what I've realized now doing this 7 years is that even though it's something I really want to do, we try real hard to do it. We have 80% of our teams survive, but also 80% of our teams go on and raise significant follow-on capital. Even though those are all big priorities for us, we still ultimately start to fall down a little bit on that and start to fail the more companies we add over time. So I think you have to always take this on yourself and just understand there's a math problem there, that it doesn't take very many companies in a portfolio to quickly consume the relationships that they have to find you capital. So never take for granted, and I doubt many people on a call like this are, but never take for granted that capital, that somebody's going to help you get that capital. It's always on you guys. It's always on you. So, anyways, that's been on my mind because I saw the last few years, we've had a very successful run with our teams being able to raise capital. But I got to say, most of that is on the founders themselves, because again, we just have, I mean, right now I have, that I know of, I have 30 companies raising capital that I'm helping. Okay. That's a lot of outreach. If I'm going to send out 5 to 10 introductions each, do the math. I mean, and that's this month, and last month was the same. So it's just something that we don't think about. Is somebody was on earlier saying they're a data scientist, and that's my background. So everything to me converts into, and I know Bonnie, you love it too. So it's like everything converts into numbers for me. It's always a math problem there, guys.
Well, I want to add some texture to that, because everything you said is absolutely true, of course. And having run this family office, and we did our own securities research, so we had to sit across from the clients and explain why we bought something and it went down. I mean, that process of facing the clients is the next step of investment management. And I saw this. My clients were asking me to, as I got active in angel investing, they were asking me to help them. And so I was making some introductions, a bit like what you were doing, not at the scale you're doing now, Glenn, and I was still tangentially accountable for the outcome of that transaction. And they also relied on me to try and chase down information from the startups because they never heard from the startups if they wrote a check, right? These are all the things that inform AngelSpan's original architecture and definitely Angel Legacy. Is how can you optimize on that process? What did I see from the clients? And they want to come through a trusted advisor, which I was by definition, but they also didn't really want to have to make the decision themselves. That was a bridge too far. They wanted something recommended to them, but they wanted it made easy for them. So they also didn't have follow-on brain damage of tracking it and all the things that Glenn was touching on. And this again was the inspiration for AngelSpan, because I saw firsthand, I was part of an angel group that was out of eBay founders. It was originally called eBay Angels, and then they changed it as the internet was exploding to Nothing But Net. That's what they called the angel group. But there was 7 eBay early employees that had a bunch of money from the IPO. And then one of the guys, Gary Dillabo, was on eBay's venture committee for their venture arm. And he saw these deals that were vetted by the venture committee, showing up, traveling across the country to try and get some money from eBay to put on their cap table. And then they were going home, and he thought, shit, why don't we form an angel group real quick and let them stay around and pitch us in the evening time, because they'd already been pre-vetted. And a client of mine called and said, hey, I got invited to join an angel group. What's an angel group, and should I join? And I said, well, tell me about it. And he told me, and I said, yes, you should, and I want to join. So he was technically the first non-eBay employee as the 8th member. I was the 9th. And this thing exploded to about 120 people coming when they opened it up. And it was more eBay people and more non-eBay people. And we're seeing 3 deals every 2 weeks at eBay's headquarters that had already been pre-vetted. And it was unbelievable. You had a marketplace taking place at eBay's headquarters every 2 weeks in the evening time. And it was unbelievable. And some people were investing in this deal, some people were investing in that deal. And the whole group imploded on itself. Because managing all that deal flow, just who's taking the lead on the last due diligence questions we wanted answered before anybody was going to write you, all that sort of process, investment process, was what was lacking. And it's still lacking. And that is the point, is that the way I manage money in the public markets was we were completely data driven. I architected a process, built a back office to support an efficient execution of that process. And we'd spend an hour and a half a week from the time we walked into the research room to when all trades were already settled in our clients' accounts. That's all we spent. 3 of us walking in once a week and spending about an hour and a half. Because we architected a process to execute that process. And that's really what's lacking, because if you don't have that sort of infrastructure to support active and proper investment management, then what you get is what we have in the venture world, a colossally inefficient process where well-intended people with lots of access to resources like Glenn and lots of expertise can't serve the very audience that he is serving and he wants to serve. And that's just a process and infrastructure vacuum. And this is not casting dispersions on Glenn. It's the very process itself.
Yeah,
and so this is what that Bart Madden, that PhD scientist guy, realized, because if you understand efficient market theory, if you solve for the inefficiencies of a marketplace's behavior, then you have a lower cost of capital for one side of that marketplace, i.e. startups. And you also have investors viewing it more like an asset class and less risky than trying to process doing a transaction by transaction basis. It's the basic market theory is efficient markets. Efficient flow of information results in efficient flow of capital. And that's what still is missing.
There's another piece there, Joe. As you were talking, it occurred to me, because angel groups are basically a microcosm that they're a really great example of the dynamic that a hedge or that a venture fund has with its co-investors. There's somebody running it, which is like the fund manager, and then there's a bunch of these investors. What you need, I think, that is happening now, which is probably why some capital is freeing up, is we were in this cycle where we weren't seeing a lot of new fund creation. We weren't seeing fund launches. We weren't even seeing new capital coming into existing funds. You have to have new funds, new capital, new launches because there's a greater velocity at the beginning of a fund than there is at the end of the fund. And the same is true with angel groups. When you see an angel group form, it does a lot of investments and then it slows its pace. And there's a lot of reasons for that. That's a much longer conversation. Some of that is knowing the realm of possible and having seen enough deals and getting more cynical. And but part of it too is also just that they're this challenge that I'm talking about, where they're starting to exhaust the capital pools, right? So their ability, part of your acceleration comes down as your ability to get follow-on leads for your deals slows. You have to slow your pacing to allow your follow-on capital to catch its breath. And the same thing is true in all these groups. So the last few years post-COVID, coming out of COVID, capital markets were tough for founders because there weren't a lot of new funds being created. Family offices and first sources of capital weren't deploying new capital into existing funds. And so you saw the pacing had already been slowing and it just continued to go to glacial. So I think what's happening now, we've seen a number of new capital sources come into the market. We've seen funds get recapitalized. You know, I was talking earlier that we're going to launch our fund. One of the reasons we're going to be using Joe's tools as well, but one of the reasons that we're figuring all that out, but we're going to be launching a new fund. So it's like that, then I bring all this up because, again, I always am talking to founders. Apologies for anybody on the call who's not a founder. All I ever think about is founders. It's the only world I live in. Even as a personal investor, I had 100+ startup investments before I launched Quake, and I still think like a founder. I can't help it. It's who I am. So all the advice I ever give is for founders, and for founders that are on this call, capital is going to get easier to get to over the next, it's naturally happening because we're seeing capital come into the front end of the market and they're going to deploy it. And the pace of deployment is going to be much faster than we've seen over the last 3 years. No question in my mind about that. Regardless of the economy, which I think sucks, I think that'll happen any which way.
Glenn, thank you for saying that, because I've said this and Alec has heard it time again. I'm always thinking from the investor's perspective. What a lovely blend. I'm always thinking from the investor's perspective because there is piles of money. And again, I'm speaking specifically that the number 2 behind Larry Fink at BlackRock was interviewed in Barron's a couple of years ago. And he said there's probably $50 trillion globally in the hands of wealthy individuals interested in investing in this asset class. Okay. Wow. There isn't a shortage of money. It's an inefficient market that isn't able to mobilize that money on terms that are favorable to investors. That's why the money doesn't get motivated. That's why we have, when you look at the amount of money that came into venture, the old system, which I call it the old traditional venture model, could not handle the money because some of the late stage money was PE money, and they also, the perverse incentives. We go on for hours, but it really wasn't built. The traditional venture fund process and model wasn't built for the sheer volume of entrepreneurship that's taking place and the amount of money that actually is now interested in the asset class. It was a cottage industry. Everything that was lower in numbers of VCs, lower in number of startups, lower velocity of transactions. And that was fine and suitable, but the system hasn't grown and innovated to handle the capacity of entrepreneurship, the diversity of business models and profiles of entrepreneurs and geographic dispersions and all these sorts of things. And that money is sitting on the sidelines because the industry hasn't accommodated for a higher velocity and treating it more like an asset class and less like a transactional approach to slowly and in an analog world, assembling a collection of holdings. Because most participants, the early adopters of angel investing and early stage investing, we'll call it VCs and angel groups, they don't have the depth of capital. Everything Glenn said is correct. And then what happens oftentimes is the angel groups have about 18 months, they have turnover of their membership.
Yeah, they can't keep deploying. They have a limited number of deals that each person can do. And part of that's capital and part of it's management. It's hard to, it's hard to track with a spreadsheet. And they, they don't want to run a company. So
they don't want to run a company. They want to dabble. And then because of the illiquidity, and then oftentimes the hangover effect. Oh shit, why did I invest in that again? Oh, I got caught up in the angel group.
That's
FOMO.
actually a great, that's a great thing, Joe, to talk. You and I have joked about this. We were talking about boats and planes earlier. A huge part of the investment with the super high nets anyway, and families is and now it's impact, but it was what you can talk about with friends I'm just going to say, what can you talk about at cocktail parties? It's not exactly that trite, but it was racehorses, it was yachts. Then it became startups. Startups are a thing you can talk about. Well, now it's like impact became pretty well, no, but like impact startups became another niche within startups that you want to be able to talk about something that is interesting, sort of sexy, something that you can talk about that's kind of gets people's attention. So part of that, again, switching back, and you can talk from the investor side, but from the founder side, is coming up with a messaging that your investors can be proud about talking about. I mean, that's it's so often lost. I'm a numbers guy, but you want to put your investment thesis in terms that the investor, when they're not sitting in a room with you and are sitting at a bar with somebody else, can bring up as an interesting story they can feel good about. Why did we invest in this company? Not just, doesn't have to be impact, by the way. I'm really curious about, Scott, you and John were talking at the beginning about your startup, and I'm reading between the lines, but if you're suggesting that you can stitch together video, I'm very intrigued by that from some defense work that I did a long time ago. But those are the types of things, like it doesn't have to be an impact based thing. It just has to be something that is really random and cool and interesting that you can insert into a conversation. Believe it or not, and Joe will fricking hate this, but he knows it's true. There are tons of investments that are made that way. I mean,
absolutely.
It's not my thesis, but I would say it's probably the dominating super angel thesis.
Yep.
Glenn, you're absolutely right. And that's the limbic brain. If you understand what studying, we've talked about the psychology of wealth. You have to engage the limbic brain to get somebody to write a check, either for philanthropy or investing. That's just a fact. And that's what Glenn is really getting to, is they have to have something to be able to be excited about and talk about in some capacity. But they have to have that feeling, which is the limbic brain. The other thing that what causes the sort of the tail wagging the dog of emotions is what's called prospect theory. And for any individual making a decision, this is a broad characterization, but it applies. The prospects for loss is twice as impactful on their decision making than the prospects for gain.
So true.
Now, in the audience, Glenn just accurately assessed, it could be loss of social status, right? They think they're part of this crowd and they want to have something to talk about that they've done to just maintain their social status. So loss of social status is how you get people to write a check to a big check to a philanthropy they don't care about, but the bigger dog in their community whose name is on the building has twisted their arm, and now all of a sudden they write a check to philanthropy because they don't want to lose social status in the eyes of the person that's twisting their arm. This is a common and tactic, and this is what fuels it. And again, that's good news and bad news. You can use it to your advantage, but you should use it for good investment practices, enlightened behavior, not just a FOMO to get dumb money that's going to get caught up in the narrative and then regret it after the fact. Go, oh shit, what did I do? Which is what happens to a lot of angels. I've seen it over 30 years, well, 29 years now, is that the angel groups themselves as an organizational dynamic is an atrocious place to actually do investing. And for entrepreneurs, it's a colossal waste of time oftentimes. But they're out there, and
you've got the social reasons. You've got the herd mentality, but where the situation, and I don't want to talk down to angel groups. There's some good ones out there. You and I know there are a few, but a lot of them, the challenge you run into, and you really have to, there are techniques and methods you can use to control the outcome at angel groups much better. The one leading reason that you fail at an angel group, if you've got a good startup and a good story, is because one person in the room drives the outcome negatively.
Yep.
So everybody's on board, but all it takes is one. So you really have to understand the dynamic, and you have to be able to engage with the you need to be able to engage with all the potential negative questions before you leave the room. And there's very specific ways to do that. I'd be happy to talk to anybody about that. Joe, did you want to turn it around? I mean, just in terms of letting people, maybe Bonnie, do you want to just take some questions today and see if, I mean, because I'm kind of curious where people are at. We're in a really weird time.
Because Dr. Brian posted something in the chat, and I'm sure people have questions. So go ahead, guys. This is your forum.
Oh, yep.
Adina has her hand up.
Yeah. Oh, go ahead, Adina. I'll follow up after her.
Thank you for that talk. Glenn, I just had a question for you. You mentioned it was the onus on the founder to always be seeking funding. And in dealing with founders, what qualities have you found that have made them successful overall?
Yeah, I mean, for me, there you hear this repeating word from me, which is authenticity, and it's just I go back and back and back and back. It comes through in there's several things. Authenticity takes a lot of forms. So I always tell my founders, put your phone down, put your tablet down, set things aside, be present, be engaged, be in the moment. Whatever conversation you're in, if it was important enough to sit down, it's the most important conversation you're having. You're not going to lose a deal in 3 minutes. I've been doing this a long time. Billions of dollars in transactions never happened to me. I don't believe it'll happen I just don't believe it'll happen. So be engaged, be present, be that. But authenticity, that's just sort of an extension of that. Being true to yourself, the language you use, don't try and present in a different form than you're comfortable with. Fall into your roots, wherever you came from. That's part of what we're investing in. When I talk, I'm investing in you as much. And by the way, here's the other thing. I'm not hardly ever investing in your product. Founders make this horrible mistake constantly. 99% of the deals I look at are products. I'm investing in your business. Your product is interesting, but it's not overwhelmingly compelling by itself. That may sound utterly insane, but you can make the best product in the world. If you ever get a chance, go watch The Simpsons and look at the Homer. You can make the best product in the world, and not that was, but the product isn't what you're actually going to invest in. It's the go-to-market, it's the team, it's the overall mission, it's the long-term vision for the company, the business. And so I think founders, a couple things that I throw a lot at the wall there, but they're important pieces. Don't pitch your product, pitch your business. Pitch yourself and all of yourself, where you came from. The dents and dings are as important as the polish and shine. And I always ask founders to give me the high level, because how they arrived at the problem set that they're solving is usually so critically important. Did they come at it like Slack, where they were solving their own problem and it became a real business? Or did they come at it because they were sitting on the outside but knew the sector and decided to do some research on the sector? And so how attached are they to this problem? That's authenticity too. And so I think that being true to your background, being true to yourself, being true to your language, and presenting in a very authentic way to the founder or to the investor who's going to invest in the founder is critical. And a lot of founders miss that. Obviously there's other things, having good traction and metrics. And look, I'm a data-driven investor, so that's hugely important to me. I'm not going to lie. But at the end of the day, we're going to have a relationship, a very close one. So it's not so much though I would argue that's it. There's trust. I have to be interested in interacting with you. That's how I'll put it. We don't have to go hang out, barbecue together, whatever, but I have to enjoy spending time with that founder, right?
Thank you.
Scott.
Appreciate it.
Thanks. Scott, you're up.
Thank you. My question, actually, when Glenn was talking to Shelley earlier, it was good to hear what you said, because we're not looking for like 20 million right now. We're just like, so we'll email you every day. But all jokes aside, all jokes aside, as John mentioned earlier, we've have our product working with 95% of usage, but having it, not seeing it before, it's been difficult trying to get this working 100%, which is what we're trying to do before we present it. But my question to you is, once we get some angel investing and we're moving on, as far as traction, would you and Joe suggest that we would offer it for free to users, or have a monthly bill or charge them, or have like a free trial and then start a monthly charge? Now, the people who would pay would be what we would call the producers, or the people who would be creating the project. The other users that they would invite in will be part of it, so they won't have to pay. So we're trying to get that, because obviously if somebody's going to invest more money, eventually they want to see us have traction and have a lot of users. And I don't know if John wants to throw in anything on top of this. He could speak probably about our product better than I can.
Yeah, but you can tell that Scott is our CFO, because that's the stuff that I depend on him for, to really raise those questions.
Yeah. I mean, Joe, I know I just went, but if I can just mention a few things real quick from the data side. I don't know your business like to the degree that I'd like to. I actually want to learn more about it because I'm intrigued by what it might be doing. We can do that offline. But what I would say, I'm not a fan of free. I'm going to start there. I want to have a conversation about that, maybe separate from your company. Free creates really crappy data. So what your goal is as a startup founder, one of the reasons I think I was successful as a startup founder is I was really good at lather, rinse, repeat, the old shampoo adage, right? So, and really what that comes down to is collecting data, seeing what the impact is. I'm going to use Head and Shoulders. Do I have flakes? Yes. Okay. Well, that's, do I not? Okay. It worked. So we're doing data, we're collecting data, we're constantly collecting data. Well, in order to do that effectively, you have to have really good pools of data. Like the people you're collecting the data from have to be valid sources of data. Kind of like with AI, it has to be properly curated data to be worthy, high quality. The problem with free is it's not. It sucks. It's horrible. It will give you almost no usable data relative to buying. So the difference between, it's sort of why betting markets generally, I know there's a lot of debate about this and we're in election season and people are very political, but historically, I'm just going to talk historically, betting markets are better at determining rather the outcome of an election than polling. This polling is free and people take their wallet out. They're pretty damn convinced and they're convicted. They're very much strong in their convictions. The same is true when you give a product away. You won't get the same kind of feedback and it won't drive the decisions or the input that you need to make decisions about paying customers. So be very careful with that, whether that's free moving to paid or whether that's free. Now, how do you deal with that? Well, you can do, there's a big difference between doing test marketing and doing small groups and doing limited time than there is to just give your product away with a freemium component or give your product away and think you're going to get, analysis from it. So I think you can do some of that, but I would just take the data very much. I would not expect that data is going to give you a lot of really good feedback. What it is going to do. Now, I did want to talk about one other thing, Joe, sorry, I'm going off here, but I've just got so many startups.
Wait, can I just say one thing?
Yeah,
I agree with everything you said so far. Keep going.
Okay. Well, the other thing I would say is you were talking about 95%, and I want to be careful here because perfect's the enemy of the good. And I think that I'll give you an example. You need to look at the market you're in. Again, I don't know it, but we've got a company that deciphers indecipherable speech. And, so you had a stroke or cerebral palsy or some other issue where I couldn't understand you. Well, your sound wave is consistent. The computer can, if it's trained. And other solutions are 20% accuracy, and that company's solutions are at 80% accuracy. Well, it's still 20% inaccurate, right? But it's 4 times better than everybody else. So I think part of what you guys need to do, instead of saying, well, we can't get it 100%, you're never probably going to get it 100%. So the question is, what is out there? What is commercially available? What's that look like? And how much differentiated from that are you? And then you start to look for the customers that really feel that pain in a major, major way. That's why, again, I've done some of this work at airports and high secure facilities with stitching cameras together, which got me interested in, I'll just use again another political example, but it's not meant to be. I just know there were a lot of cell phone footage from the first Trump assassination. It's been made quite newsworthy that there was all this cell phone footage that they were compiling. I don't know the current state of that business, but whoever's out there building software that can consolidate a bunch of different inbound mobile data feeds is going to do really, really well. So there's you look at that and you say, well, what is the current state of that? Who's feeling the pain? Defense in that particular instance would be a great example, but there are others. And then you start to attack that specific vertical with your improvement over the baseline. And that's what I would do. I wouldn't worry about the 5%. I'd worry about the 60% that everybody else is at, or the 40% or whatever it is. Anyways, that's I attack everything as a founder. Right. Sorry, Joe. That was just,
No,
I couldn't help it.
Well, look at it.
It's
Everything he
more
said, I
knowledge.
couldn't agree with more. And as a founder of AngelSpan, we were faced with the same advice. Give it away to get users so you can show traction to get money. And what we found early on is even with the startups that it's just human nature that if you're not paying for it, you don't value it, right? By definition. So even your usage is not going to be good data to model your business strategy on, as to Glenn's point. And what we found is, again, we could quickly elevate the quality of our startups by simply charging the quality of the startups and thus the quality of the data. And then we found.
Joe, did you see the problems were the same too? What I mean by that is one of the things you see in the data when you do free is you get all kinds of feature requests all over the board.
Oh God, yes. Oh,
and when you do paid, you find that there's a homogeny to the requirements. Did you see that? I'm just curious if you.
Well, yeah, absolutely. I mean, we saw several stages because we played with pricing in a variety of ways. And again, paying for it, we elevated the quality of the startups, which means the quality of the data, right? Do you want to build a business on that audience of startups that largely are going to fail? No. What's the point, right? The link between transparency and success is clear. And if they don't value it, they're not going to use it. And if you don't charge, they're not going to value it. And even those that are paying for our service, we found how they use us also has a profound correlation to their eventual success. So it's all these things that Glenn have said is absolutely spot on. And for us, again, part of our goal is, again, thinking from an investor's perspective is how can we facilitate more efficient investing? So raise the velocity and the quality of the outcomes for the investor side. Because we can have an impact on mobilizing more money. All startups are going to win, good and bad, successful and unsuccessful, right? That's where the lower cost of capital comes in. So everybody's going to win on that one if we can mobilize more money. So how do you mobilize more money? Well, we've got to help them understand how to make better investment decisions, better being in process and outcomes. And so for us, that data was critically important because you don't want to help people invest a lot of money efficiently in a bunch of crap startups.
You kill the flywheel.
You kill the flywheel.
I see Dark Bonnie has her hand up. I see that.
Dark Bonnie.
From the historic perspective, remember when Web 1.0 started, it was the new economy. Everybody was talking about the new economy, and it was all about eyeballs and don't worry about the money and blah, blah, blah. So we had, at first, Google, with later, Facebook, and who invested in them because they didn't have to worry about money. The three-letter people.
Three-letter agencies.
Yes. So and that's how we got the surveillance state. But this was drummed into our head, just eyeballs. Well, who really has the eyeballs? It's those three-letter agencies. So that's all I wanted to add. Thank you.
Yeah, I've had a few NQTel investments. I know.
Yeah.
Jimmy had a hand up early on too, and I think you said that Brian had something in the chat.
Yeah, Brian. Yes. Yeah. So, Brian, do you want to? Oh, go ahead.
Thank you. My question is, my background, Glenn, from engineering, real estate, food, and my family with chronic health diseases. My vision is to really democratize AI for healthcare and all those sectors. So when you talk about go to market on a freemium versus like being paid. I've done a little bit of research on the different platforms that offer, that freemium, and then, for deeper analysis or features, then you do the paid. What are your thoughts about having a marketplace that really wants to democratize and have everybody utilize this technology? And at the same time, if you want more advanced stuff, then you pay for it. So what are your thoughts on that?
Yeah, that's a slightly different problem. I think you've raised a really good example of where, almost anything that I spout or anybody spouts is going to have some exception. And I think this is a great example of that. There are certain cases around, again, if you're a for-profit business, you got to figure out a way to make the model work to actually become successful and make money for your investors and actually make money for you to support your team and your employees and so on. But if your message and your mission and your story is to support like an open access, then obviously that requires that's your model, right? That's like your whole reason for being, right? So there's going to be an exception that's in there. I gave Voice It as an example. In that scenario, it's and that's the company that does the indecipherable speech, and is Israeli company. That is, if you look at it, they have large partnerships with some of these players that are like AARP. They have partnerships with government agencies that want to get this in the hands of seniors and assisted living facilities and things like that. So they found ways to make it free with some sponsors and supporters and things like that. Now, if you're going to make an open marketplace, I think the model you suggested can work. I just think you have to be really careful with the data you collect. So what I would do is I would segregate the data. And that's what I always tell my founders. If you need to have a free pool because that's your mission, I want to help as many people as I can with these basic tools. Okay, fine. But segregate that data hard from the paid data that you get, because if you try and use that free data to tell you how a paid user is going to react, it's not going to be accurate. That's all I would suggest to you. So I'm not going to look at that as an investor and say, well, this is a shitty business model, because that's your mission, is to help. That's a
branding. It's a branding opportunity. Yeah.
And it's a credible reason to launch. Like, if you see a real problem, you're going to get a larger access by being, by trying to solve this overwhelming problem. That's fine. And then your paid solution is a niche within that's affecting a smaller subset. We see that in business models all the time. Maybe take out free and replace with lower margin, loss leader, right? These are things we see in business models all the time. So that's okay. Joe, were you?
Awesome. Thank you.
Oh, no, I was saying goodbye to Brian. Brian had to drop.
Yes.
The chat. No, I there's no way in hell I'm going to, if you're an entrepreneur wanting advice, talk to him. Don't talk to me. If you're an investor wanting advice, talk to me.
Oh, I had one more question. What are your thoughts on the tax code that's been there for, decades, that Joe always talks about, the 1202, 1244? What are your thoughts on that? Love to hear your perspective.
It's huge from we saw, I think I told Joe, we were in a private conversation, maybe Bonnie was on it too. We were talking about, when I launched Quake 7 years ago, it was a big deal with investors. It had gotten newsworthy. I don't remember why, if you would know, Joe, why at the time it had gotten newsworthy again around that time. Not the extension you're talking about now, or the changes you're talking about now, but the fact that you could basically roll it, and keep your, extend your long-term gains and not pay the tax and all that, had gotten noteworthy. There'd been some articles written. And I can tell you from Quake's perspective, it had a huge impact on raising the first fund. So is it something that not only is it something that is important in general, if it happens, or even if it doesn't, it still sits out there today. Founders should be talking to investors about how they can roll from. So here's an example. If you're talking to an investor and and if they're super sophisticated, they probably know, but a lot of investors don't even know this exists. So if you know that they had an exit recently, which is where a lot of this capital comes from. As a founder, you found out somebody had an exit, they've got some capital. Absolutely should be incorporated into your dialogue with that investor. That's what we did even as a fund. So yeah, I think it's a huge deal. I think extending it and adjusting it for modern times would be really, getting it in line with, basically the current rates of inflation and the cost of living and all this shit that's going on in the world. It needs to be updated, but that's not really the issue for the founder. The issue for the founder is take advantage of it, use it, incorporate it. Don't put it in your deck. Don't put it in your deck because it's just too esoteric, but bring it into the conversation.
Yeah, put it in the appendix, and that sort of stuff. You don't lead with it because well, I've talked to thousands of people over the last 20 plus years on QSBS, and I've found that about 2/3 of the people I talk to when you tell them about it, their brain shuts off because they're fearful of the tax code and they're thinking, well, I got an accountant that will know this, so I don't even want to think about this. And this is from investors or they're all walks. They literally shut down and they don't listen. When you're talking to advisors,
won't know about it. Yeah.
What's that?
And their accountant very likely won't know about it because they don't deal with this. Yeah.
Absolutely. If you're talking to the advisors to an investor, like who I used to be, they all go, holy shit, this is a big deal. And why doesn't more people know about it? Because if you've handled people's money, you know that taxes are a major influence on a lot of their decisions. About 85% of their estate planning decisions are all about tax minimization. So wealthy people are highly motivated by the after-tax implications, highly motivated. Now, how you spoon feed it, it's best to, and again, I've done this a lot, is to say, let me talk to your advisor about this. Let me talk to who's your financial advisor.
That's a great way to do it. Take it off there.
Yeah.
I'll give you another quick example, Jimmy. You brought in this, but we have a team right now who's got a footprint in Indiana. They're not even based there. And Indiana has this interesting program where you can get tax credits in the state of Indiana. And you'd think, oh, who gives a crap? It's tax credits in Indiana. 20% of the amount capital raised, the people who put that money in can get 20% of their capital back in the form of tax credits. Cool thing is you can turn around and sell them on a state-run exchange to other people in the state of Indiana to actually get your 20%. Now that sounds awesome, right? I put in 100,000, I get 20,000 back. That's a great thing to sell. The founder was pitching it. It's in his deck. It's all over. It's great. That sucked. Like nobody cared. Like they love it. They love it. But in the deck, it's not the business. It wasn't interesting. They don't even understand it. I'm not in Indiana. What is this marketplace? You have to get into the conversation and then you roll that in. Sideline of that is check and see if there's anything in your state like that, because it actually is a really powerful thing. And there are several states that do that.
This is what England does. And that's why their startups in England can get started, but there's no depth of capital in England because so much of you get 100% tax credit in England for investing in startups. So you literally have no money in it. Problem is for the startups that can get that early stage money because of the tax credit, there's no follow-on money. So they just die in England. So taxes are highly powerful in mobilizing investors' behavior, but Glenn is spot on. You use that almost to close the deal unless you can find somebody that actually had a recent exit, because to roll it over, they have to do it within 60 days. So you actually the tax code gives urgency that you don't have to create some false sense of urgency. Hey, were you aware? I understand you had a recent exit. From the looks of the transaction, it was probably QSBS qualified. Are you aware of that? Well, did you know? And I've got all the materials if you want to use that tactic and send them the actual code and illustrations, simplified. It's easier to read. But point being is that you can use 1040, it's called a 1045 exchange, where you can literally get people to invest because they just got an exit, but it happened inside a 5-year window, which is what you have to have a holding period before you can get to the tax-free profits. So they can roll it over, pure and simple. And that's a big deal. We've got a LinkedIn a group called QSBS Marketplace. And part of our vision for that is just this very thing. AngelSpan clients that are our best clients based on the performance and the analytics will be able to post there, not violate Reg D offerings, but post and say, we're QSBS qualified and we've got an open term sheet. Do you have an exit recently? Here's our materials. And it's AngelSpan's tear sheet and all the sort of things that we've got. So that's part of our vision, is to facilitate investors being able to roll over money efficiently, because they only have a 60-day window to do it from the time they got the cash from their exit. That's raising the velocity of money and helping investors invest better. That's just one of the tactics of part of our vision.
And Ian.
Yeah, so we were talking earlier about transparency. And I heard a report this morning. They said basically PE firms are not very transparent. And I think the same thing applies to VC funds. I mean, what do you have to say about that? Is it's just confusion? They can't do it because they have everything in spreadsheets and can't easily do it.
No, it's nothing that innocent is their reason.
Okay.
Well, it's both. They suck at it. We can admit that. I mean, I think a lot of funds, we've talked about, a lot of funds really suck at their diligence. They suck at tracking. They suck at, I mean, almost all aspects. It's hilarious, but
this is all back office. This is all back office infrastructure that to start a venture fund. I don't know about PE as well, but to start a venture fund under $100 million, you have virtually no oversight or requirements. Zero expectations of you. You don't have to file with the SEC. You don't have to do anything. There's virtually no expectations. And so that absence of professional expectations allows anybody to launch a fund and clog up the conversations with entrepreneurs. And LPs that'll be susceptible to that don't understand the importance of these things, which is a lot of the LPs and early stage venture funds. They don't understand the importance of it and how much they're going to suffer as an LP down the road in that years 2, 3, 4, the dark years where the J curve is going down and their capital account's going down and there's no activity to speak of on the part of the portfolio company. So it's wildly important. It's part of the real flaws of venture capital. I can't speak to PE. I've followed PE forever. And yes, that was nefariously avoided in the PE world. They wanted to keep it as black box as possible. And that's the VC industry has largely perpetuated that.
Right, and Congress kind of perpetuates that. I mean,
oh yeah, there's been bills, and then the NVCA or there's an equivalent for the private equity world. They go in and lobby hard, and at the last minute, just recently, Gensler, who's banging the SEC head, who's banging the drum of transparency and Reg D offerings, whether you're launching a fund or an individual startup raising money. They were leaning hard on transparency. The last minute, it got neutralized. The legs got cut out from it. That's lobbying.
And it will. Now there is a challenge too, though, Joe. If it goes too far, where you'll end up cutting the legs out of, $5, $10, $15 million funds will have trouble if they increase the cost required. So I don't. There's a balance they're going to have to strike at some level there.
That's an interesting debate.
I know where you and I landed. We've had it before, so I know we landed in a slightly different place. But I think that they're, right now, if you look at it, so Quake on any of our funds, we probably spend $400,000 a year between the audits, third-party administrators, legal, right? Yeah, so it's expensive. Now, again, how you choose to do that is, I think we do full audit. We don't do a UAP. We do, and we've got 300 teams. And so it's a whole different thing. But going back to Ian's question real quick, or comment real quick, I think they suck at it, everything Joe said, but then also too, on top of that, there are a lot of hacks and tricks that funds use to juice returns that if they were really transparent would be obvious. And I didn't know a lot of this when I was on the outside and I got in and I'm like, how is that shitty fund doing better? And I look at how they have a follow-on fund that's investing in their earlier deals. They have a co-investment agreement with another fund that comes into their deals. These are markups that impact the IRR. There's lots of weird shit that happens. There's lots of good funds too. I'm not trying to, we're a top performing fund, so I'm not really big on throwing stones. If somebody's better than us, they're better than us. But there are groups out there, and I learned this mostly from investors who'd been screwed, there are groups out there that are juicing the system. And if they're really, really transparent, it would become apparent that they're juicing the system with other, basically think of it like double dipping capital would be probably a good way to look at it. Or they can do interesting things like, I don't know how much I want to get into, but it's probably esoteric, but there's lots of things they can do on the fund structure side that artificially inflates who owns what kind of yield there is. There's just lots of games that are going on.
And that only happens in shadows. If you study systems, optimal systems design, transparency is a first principle of optimal system design. And when you see an industry avoiding it and spending money to avoid transparency, that's all you got to know.
Yeah.
That's my opinion.
My updates and reports are like ridiculously overdone because it's what I wanted.
That's right. But that's why you've also been successful as an entrepreneur, because you understand the importance of transparency. That's the research confirms that. And you lean into it because it's the right thing to do, not because somebody beat you over the head over it.
Yeah.
That's exactly right. Your success is evidenced by that very thing, that very point.
But I guess it would be better for everybody if all these firms are more transparent.
You think?
Yeah, I 100% agree. Even to the extent, I arguing against myself, even on the cost side, I'm still in favor of it. I just would love to see it. I don't want to take money. Elon told a great story. I don't know how many of you heard it the other day about hitting the shark. Do you guys hear that story? He's talking about how he had to do. He's talking about somebody asked him a question.
Yeah, that seal.
No, it was a shark and a whale. So they were asking, why don't you like regulation? He said, I don't dislike regulation. So then they went into a further conversation, basically, and he's told the story a few times now, and it got filmed once, but he was basically saying how he had to do a regulatory report for the National Fisheries Association about his rocket, coming back down. Will it hit a shark? And he's like, what? And so he said, can I get the information on sharks? Because my team doesn't have that information. They said, no. He said, what do you mean no? And he said, well, we could share it with the Western Division, but we don't trust them. And he's like, what? So he finally gets the data on sharks, which you already know the outcome of this. Stick a pin in a map of the ocean. That's his odds of hitting a shark. And so he comes back and says, no, we're very unlikely we're going to hit a shark. And if we do, we're going to hit one shark. And then they said, what about whales? And why do I tell you this? Because this is my fear. Like, I'm great for us having full transparency and the government stepping in and putting, what I don't want to see is them basically come so over the top that there are loads of first funds that are $5 million and $10 million, and we need them. We critically need them. We need a shit ton more of them than we have today. And if you end up having anywhere from 200, we got away with it because I funded it. But if you have anywhere from $200,000 to $500,000 in cost, that's impossible on a fund like that. So you just can't do it. So I think, that's the only concern I have is a balance, just balance.
Couldn't agree more.
But you guys have time for a couple more questions? Because Kyle has one and then Jimmy has one.
Sure.
Okay, Kyle.
Thanks, Bonnie. Great discussion. So moving on from sharks and whales, and trying to preface into venture studios. What are your thoughts on the prevalence of venture studios now? Are they just another disguise in the accelerator and incubator world? I think some angel groups do a lot of education. I'm part of one here in Colorado, the Rockies Venture Club, and we definitely try to take the education part seriously and try to prepare investors. Founders and investors if they're not ready to get that funding. But I've seen a lot of venture studios popping up. Your thoughts on venture studios, and are they filling a need, or is it just another disguise?
Wow, great question.
You've got a longer answer. Let me give you a quick answer, and then you can give a long answer, because Quake has got accelerator, so he's more experienced in this. But I'm always observing it from a system standpoint, and I think that the venture studio model is a healthy evolution. One of the challenges is that remains, because we interact with a lot of venture studios, is the business model, right? If you're truly going to add value, that's like the old venture fund model, where the velocity of investing activity is very slow. You have a concentrated portfolio, and they really roll up their sleeves and work with entrepreneurs they probably knew, that sort of stuff. And so they do very much like what we would think a venture studio is aspiring to be. The problem is in the current environment, that business model doesn't work. The venture studio has to have a revenue source, and you can't charge the startups because if you're going to be a good venture studio, it's a concentrated number of companies that you're really going deep with, and you can't charge them enough to pay for all the people that purportedly is going to add value in the studio. You got a staffing compensation issue, and just volunteer mentors, that's the worst example of the old accelerator model, right? So they always have companion funds, but then they lose sight of who their customer is. In the studio side, it is the entrepreneur, but on the venture fund side, it's the LPs. And what they want the revenue from the management fee to support the overhead of the studio. But at the end of the day, they also want to validate by investing the LP's money in their studio products. Well, they're not objective. There needs to be a Chinese wall between who's making investment decisions and who is doing the venture studio value add. That's the hard part. And I've not seen one yet. And that's why I wanted to ask you, Glenn, if you've seen one that has figured that out well. Because to me, I wouldn't give a venture studio money if I was an LP, if they said, yeah, and we're going to invest in the companies that's come through our studio. Well, you have no objectivity. You're going to want to use somebody else's money to validate your value add.
Yeah,
and even knowing where that's going to work.
Even at Quake, when we first launched it as an accelerator, where we're taking 150 grand goes in, 25 comes out, right? 25 goes out to the acceleration side of the business, meaning we have a team that has to work on they come to our offices, work in our offices for 3 months. This is the old model. They come to our offices, work in our offices for 3 months. We put a team around them to help them at that time. So there's a lot of cost associated with all that. And we charged back then $25,000 out of the 150.
Okay.
That took some explaining to the founders, took some explaining to our LPs, but we put up that wall. What's interesting is the people who ran acceleration were a different team than interacted with our investor side. Okay. Because they're to Joe's point, they're very different objectives. They're very different audiences with different wants, right? And so the only way to do it effectively is that. Now, have I seen a venture studio do that? I haven't even seen an accelerator really do that. And even we failed in certain regards of that, in my opinion, because I was the one raising money, and I'm trying not to be a jerk here, but I've got far and away the most experience on our team working on startups. So I want to get involved with the startups. I'm the best, like I've got the biggest wealth of history doing that. And so I would break that wall all the damn time. So I think it's a very difficult thing. Everything Joe said, I think, is spot on. I think venture studios struggle with their business model. The ones I've seen taking the business model out of it and just talking what I've seen work for founders are niche venture models or venture studios. And I'm going to mention some accelerators because they're easier names for me, but like XRC, where you've got fashion and retail, or PPG, packaged goods, or hardware, where you see these venture studios who are focused on a particular niche market, or an accelerator even who's focused on niche market. I've seen those to be much more successful because it's there's a couple of different dynamics there. One, it's easier to get your mentors and advisors. They all feed off each other. You can get them. You can focus on local communities much more easily that way, because geographically areas seem to focus around specific things. Like, we're really focused on manufacturing. We're really focused on warehousing. We're really focused on logistics. Cities grow up around industries. So geographically, they tend to lump really well. The other thing that tends to happen is that you see the same problems. So much like a pre-seed or seed fund, I always joke that we're like a guidance counselor in high school that only sees sophomores. We see all the same problems. Like, the kids are at the same point of evolution. We're not dealing with 30-year-old therapy. We're not dealing with, preschoolers. We're dealing with a particular band. Well, make that even. You're only dealing with sophomores in Miss Jones' class who are male. Like that's really what happens. And they're all going through puberty at the same time and all that. Like that's what, if you build a venture studio that is really, really focused, it gets easy because you're seeing the same problems over and over, and you're developing solutions that you can repeat and networks that you can tie into that are repeatable. So I think that's the outside advice I would give is try and shrink your circles. It'll be a lot easier to build a successful business model.
Yeah, I wanted to
Yeah.
also, I wanted to
Spot
mention
on.
Metaprop in terms of prop tech too. They have a very specific
Oh
special.
yeah, that's a great example. Yeah,
Yeah.
for sure.
Yep. Great answer. Good. What he said.
What you both said. No, thank you for
Yeah.
that. Really brought it very wide and also very singular. So thank you for that.
Do we have time for one more? Because Jimmy has his hand raised.
Oh,
One
sure.
last one, Glenn. I know you're really big on diversity and all for everyone. Columbia went out with a study, randomized control study in 2020 on discrimination in the VC industry against females and Asian founders. What are your thoughts and perspective on that?
It's funny, the second part of that is not talked about much. Asian founders, it's really hilarious that that's not actually a bigger issue. It's funny, you're one of the first founders who's mentioned it to me, and we see it in the data. So again, we're data driven. So we didn't set out, it's funny, we didn't set out, sorry, I've kind of got an allergy problem popping
I
up
put it in
too.
the chat too.
Oh, that'd be great. Please do share that. We didn't set out to be a diverse founder fund or anything like that. Our focus was on merit. And I took a lot of heat for that, even from diverse founders in the beginning. It's like, you know, that's a big cop out that funds use. But we found what ended up happening, for those that don't know, it sounds like you've looked at us before or looked at our website or whatever. You know, we have 10 times more female founders, 10 times more Hispanic, or 6 times more Hispanic, 10 times more Black founders. Funny enough, we have a very high ratio of Asian founders. We can slice and dice it any way you want. We could get into, well, pretty much any slicing you want to do. We're going to come in a very interesting set of numbers because we focus on the back end performance of the team and the founders and in the company. In terms of what I think about it, it's all real. Look, there is a ridiculous, I don't think it's just because there are not enough women in venture. I don't think it's just because, I mean, you know, there are a lot of, you can take the demographics and slice it up. I think it's more a function, to be honest, I think a lot of it is giving back. I think when you look at the way certain pools interact, so here's some really disturbing dynamics. I think I mentioned this on the last call, or maybe it was on office hours with Joe. I don't recall, but if you take 2 similarly aged Black founders from the same household, one's male, one's female.
Yeah.
The Black male founder from that household will raise more friends and family capital than the female founder from that household. So there's a lot of cultural dynamics that come into play. Then you have the giving back that I was talking about. You need more founders to break off, exit, and put back into the community. There's less of that culturally going on than we, you know, with not just culturally by race, but also by gender. So we need to see some dynamics that there is a certain thing. I know white men get a big bad rap, and I get it. And they've gotten shitty at this now. But if you go back 30 years when I was getting started, Black or white men giving back after exiting was really, really high. So what I mean by that is they by a very high margin became investors. It was a common thing. Now they exit. I mean, exit. Like like we're seeing a change in the metrics for white men from what we saw 30 years ago. And we have long seen a lot of those trends. And what we're now seeing is that we're seeing more Black founders giving back and becoming investors. We're seeing more Hispanic founders. Asian founders actually still have stayed pretty flat. So I'm curious to see the report you've got, but the data shows that they've stayed pretty flat. And a lot of that is cultural. So, you know, I'm just learning this like everybody else. I didn't know any of this. So talking to our Black founders, one of the things that became apparent and doing some research on it is they didn't have the same conversations about money growing up in many cases. Now, look, there's wealthy black people, poor black people, wealthy white people, poor black people. But apples to apples, there were fewer conversations about money happening in those households. That's changing.
Yeah.
And there's a difference, like this striving that the white households were having towards college education and investing in things is also changing. It's actually moving the other direction a little bit. So there is a leveling happening culturally in the United States for giving back after you exit, which is going to change those numbers. But so it's a combination of things. You don't have enough diverse venture founders or GPs, general partners, managing partners of venture funds. You have a cultural divide between the investment ethos of a family, but whether that be giving to their male or female offspring and the extended family doing bootstrapping and friends and family to those rounds, or whether it be an understanding of the need to invest capital. And how to advance in society through wealth building by investing. And that's becoming much more mainstream for a lot of these cultures than it was. And then there are other things like, again, I'll have to look at the study, but it's interesting to see a study on agents because there's almost none. And the ones that I've seen have indicated that they invest entirely different than whites, blacks, Hispanics, like entirely different, like much more. I would say if I was going to put a label to it, I'd say risk adverse. So it's very different. They'd much rather build than invest in somebody else's build. So that's
Glenn,
at least my anecdotal on it.
I want to put a pin on something that you won't take credit for, I know, but you deserve to. And because the solution is what he said at the outset of his comments. Meritocracy is the ultimate leveling mechanism. And their investing is meritocratic, it's data-driven. And what happened? The byproduct was the outcome that everybody thinks should happen. So the solution is meritocracy. I love to quote Martin Luther King. It should be the content of your character, not the color of your skin, right? And that's data-driven, meritocratic metrics for who gets funding and why and how much. Full stop. That is the solution. He exercised it instinctively, and the byproduct was diversity wasn't an issue because it shouldn't be. It shouldn't be, and nor does it have to be. If you're basing it on meritocracy, you're going to crush your DEI numbers. And the opposite's true. If you're trying to lean in and lead with victimhood, it ain't going to work because there's so many other things that are going to get in the way of that actually being the path of solution. Cultural and some of the things he touched on. Meritocracy is ultimately the answer. And that's it absolutely is. And how do you solve for meritocratic decision making?
Some markets are better at this too, by the way, Joe.
What's that?
Some markets are better at this. You and I have talked about geographies like Silicon, and Bonnie too. Silicon Valley's become shitty.
Yeah.
I mean, I hate to throw stones, but it was the ultimate melting pot when I was there in 95. When I was building an internet startup in 95, it was like as diverse as you could ever imagine.
Yeah,
it was
that was
all
the
about
beginning.
merit. No, half the people didn't even go to college. Like I'm not maybe not half, but like a huge percentage didn't even go to college. They just show me what you can do.
Right. Show me what you can do.
And it's totally changed there. So some communities are much more, and I think that is I don't know what the point necessarily is, other than I guess when I'm talking to my founders, I tell them certain markets to look at depending on their break, how they break. I also would say this, Jimmy, I think you want to be really careful. I think there's a lot of founders out there, and I always try and say this on a call like this, particularly Black, Hispanic, and female. Those three groups. I'll have a founder tell me they don't want to go talk to a certain fund because they don't want to be known. These are very successful founders who bite, clawed, and scratched to get where they are. And they don't want to be known as the Black founder or the female founder. They want to be known as a great founder, right? And I'm not saying there are some who are happy with whatever identity you want to give them, but there are some founders who are like, I don't want to talk to that fund because I don't want to be known as that founder. And I'm like, what are you, crazy? Of course you want to go talk to that fund. It's like being a chip maker and not going to talk to the chip funding company. Like, I mean, it's like, you go talk to whoever is out there. That's what their LPs, what their limited partners want to invest in is that. Give them what they want. And by the way, those are going to be very active evangelical, not because the color of your skin or your gender, but because that's their thesis. They're going to be evangelical. So if you're, again, if you're an impact company, go talk to impact investors. If you're a hardware company, talk to hardware investors. If you're a Black founder, talk to, Black founder funds. It'd be crazy. Like, so I just always find that fascinating that some people are resistant to that. Don't ever be resistant to that, whatever else goes.
I wanted to mention that, as we know, Silicon Valley became a total bro culture. And what's really interesting is that all the companies that were originally built out there when tech was getting started, all the programmers were women. Because it didn't, all the programmers were women.
A ton of them.
Yep.
And again, they came from all over.
Yep.
They didn't go to the best schools. My best coders went to K-State, Kansas State. My best coders, 3 of my best coders. Actually, they all dropped out, but they all knew each other.
And most of the engineers in Silicon Valley were from San Jose State, not from Stanford or Berkeley, where everybody likes to wrap themselves. No, they were all San Jose State for the same reasons, because it was, could you do the job? It didn't matter when you went to school. Could you do the job? And that goes, like I said, this is systems design. If the current system is suboptimal, I say broken, but let's call it suboptimal, then how you design what you want it to be, and what are the components of that design? And yes, transparency is one of them, and that is necessary for a meritocratic platform where the byproduct will be what Glenn did organically and naturally, which is, yeah, you base it on meritocracy. The optics don't matter. Unfortunately, so much of the behaviors become optics driven. That's why the system is broken, because it is optics.
And I know we're coming up, we're way over, but
I know.
I'm gonna have a hard stop. But I will say this, Joe, it's sort of like that lather, rinse, repeat. It's the murder book. It's every founder. We did that at Quake. I know you do it. You tell your founders at AngelSpan. You've got to constantly be looking at the data and adapting to the data. And that's how we arrived where we arrived. Not really answering, Jimmy, anything you were talking about, but I'm just saying that's, again, even in a fund, you can do the same things that founders should be doing. That's how we arrived where we arrived.
Yeah.
Okay, I guess we should stop here. I have a funny story for you. I'll tell it to you on Friday about your software that understands hard to understand language. But I want to thank everybody and thank you guys for taking so much time. And we'll schedule another one very soon, right? After
Awesome.
Is there a way that we can connect with Glenn?
We should have mentioned to this audience, although Bonnie, you can send it to your audience about office hours on November 1st. That Glenn will be our guest speaker. So we'll do this again.
I'm posting my I'm just posting my email in the there's my email. It's real simple. Glenn with 2 N's at quake.vc. Easy.
Awesome.
What is Argenbright, by the way? Is that Dutch or German?
It's German. It's bastardized in the United States.
Yeah.
So whatever, my family on that side goes, we have a farm up in Illinois over 200 years old. So
Wow. That's cool. You still having the family?
Actually, it's sort of funny. We had a tenant farmer that we grew up with. So he's like family, and the Haney family. And we ended up selling. I didn't want to be a farmer. This is going to sound sexist, but none of my sisters wanted it either. But I was the last male child in the line. It had gone from male to male to male. I didn't want to be a farmer. And so that went, and I'm thrilled it went to Steve, because again, he's just part of the family. And then 100,000 acres on my mom's side in Texas. So huge rice farm down there.
Wow.
Whereabouts?
Hampshire, which is southeast.
Southeast, okay, yeah.
All the rice farms down that way.
All the rice farms are, yeah, sure. Yeah, cool. You come
Awesome,
down
guys.
here, you come down here in duck hunt?
I used to. That hasn't happened lately, but yeah.
Okay.
Awesome.
Thank you all.
Thanks, y'all.
Thanks, Bonnie.
Take care.
Thanks, Glenn.
Thank you. Everybody have a great day.
Have a great
All
one.
righty. All right. Bye-bye.
Thanks. Bye-bye.